So you want to avoid paying tax. You want to exploit all the loopholes possible. You hate the fact that the rich seem to avoid taxes completely and get away with it year after year after year. Well, watch and listen carefully, because in this video we're going to be explaining exactly step by step how to legally avoid paying taxes right after you smash the subscribe button, blast the like button and break the notification bell. All done? Now then, let's begin. First things first, we're going to start off with a man named Martin, and he has earned a whopping of 45 grand this year. Let's give it up for Martin, everybody. He's put in a shift. Of this income, 12,570 was tax free, so he got to take all that home. The remaining 32,430 was taxed at a rate of 20%. So of this money, he took home 25,944. We're only going to be focusing on income tax for this video. Put in the comments if you want videos on how to save on other taxes. So in total, his take-home pay was 38,514 as far as just income tax goes. And he paid a total of 6,486 in income tax. Right, let's get this down to zero. Hopefully you understand that. If not, just rewatch it, because things are about to get a little interesting. Martin decides to open a lifetime ISA and deposits 4,000 into it, which is the maximum amount you can deposit into a lifetime ISA. The government adds 25% of your contribution up to a maximum of 1,000. So you now have 5,000 in your lifetime ISA. Assuming that the S&P 500 increases by the average of 10%, the total amount in your lifetime ISA will be 5,500 at the end of the year. In this instance, we're also presuming that Martin has invested a lump sum of 4,000 into his lifetime ISA, rather than throughout the year. Because of course, he will not receive the full 1,000 from the government at the start of the year if he didn't do this. And then that would affect the return of the S&P 500. Great thing about this is he's paid 20% on his income, but managed to earn 25% back through the lifetime ISA, and a 10% return on his investment into the S&P 500 as a little bonus. So now he has 34,514 left. What should he do next? Well, next he will open up a SIP, which just stands for a self-invested personal pension. The US version of this is just a 401k. Now Martin is going to ask his employer for a contribution into his SIP. Remember, this is both tax efficient for the company and the employee when doing this. So in this case, we're going to presume that the employer agrees to this. If your employer isn't willing to contribute to your SIP, then don't worry, just skip this part. Later on, I'll be making clear what you can do in this situation. The minimum amount an employer can contribute to your SIP is 3% of your salary. So we will use this amount in the example. But it's probable that you'll be able to receive more than this. 3% of 45,000 is 1,350. So this is how much your employer will contribute into your SIP annually. Whoa, don't be thinking you're getting this for free. This 1,350 will just be paid into your SIP instead of being paid as income. Well, what's the point in that? Well, your new income now is 43,650 and the other 1,350 has gone into your SIP. So now you're only paying tax on 43,650 instead of 45,000. Remember, any contributions into your SIP are not liable for tax, so it's a win-win. Well, with this in mind, let's work out our new take-home pay and amount we have to pay in tax. As we said, 12,570 is our tax-free amount. So take that away from 43,650, and you get 31,080. Steve gets taxed 20% on 31,080, so of this money he will take home 24,864. Add this to 12,570 and he gets a total take-home pay of 37,434. So we paid in tax 6,216 in income tax. As you can see, we have reduced our income tax paid compared to before, where Martin paid 6,486. Just bear in mind that this is using the minimum amount an employer can contribute. There is no upper limit on how much an employer can contribute. If we took this example and used it with a 5% employer contribution on an annual salary of 60,000, it really starts to ramp up how much tax you can save. Employers are willing to go as high as 10, even 15%. At this stage, this loophole feels illegal. Let's go back to Martin and say, for instance, his employer wasn't willing to contribute to his SIP. For whatever reason. What can Martin do now? Well, he will simply just pay into his SIP himself. The government contributes 20% into your SIP, and this can increase to 45% and 60%, depending on what tax bracket you're in. And if you get caught by the 60% tax trap, yes, that is a thing. Martin has got 4 options that he can choose to reduce his tax to 0. Let's take a little look at them. So if Martin doesn't want to invest and chooses to just deposit money into his lifetime ISA and his SIP, he will have to deposit 4,000 into his lifetime ISA, in which he will receive 25% from the government. He will also have to deposit 27,430 into his SIP, in which he will receive 20% back from the government. So 25% of 4,000 equals 1,000, and 20% of 27,430 equals 5,486. Add them both up and he's received 6,486 in total from the government, which was equal to the income tax he paid that year. So if Martin chooses to invest this tax year and chooses the S&P 500, which has averaged a return of 10%, then he will have to deposit 4,000 into his lifetime ISA, receiving 25% from the government. And he will have to deposit 15,581 into his SIP, receiving 20% from the government. Now he will have to do this in lump sums at the beginning of the tax year to allow the investment to grow for the year. So 25% of 4,000 equals 1,000. 20% of 15,581.25 equals 31,116.25. So the total amount in the lifetime ISA will be 5,000 at the start of the tax year. This is then invested in the S&P 500 with a 10% average return, meaning a balance of 5,500 at the end of the tax year. Now minus this from your initial deposit into your lifetime ISA of 4,000, and you've made 1,500. The total amount in the SIPP will be 18,697.5 at the start of the tax year. This, of course, invested in the S&P 500, giving an average return of 10%, meaning a balance of 20,567.25 by the end of the tax year. Minus this from your initial deposit into your SIPP, and you have a final balance of 4,986. Now finally, add your profits up, and you get 6,486, again equaling the amount of tax you paid that year. If Martin can manage to get a 3% employer's contribution to this SIPP, then he will have to deposit 4,000 into his lifetime ISA, in which he will receive 25% from the government. He will also have to deposit 24,730 into his SIPP, with his employer also contributing 3% of his salary. So 3% of 45,000 is 1,350. To add these two, and a total of 26,080 has been deposited into his SIPP, in which he received 20% back from the government. So 25% of 4,000 equals 1,000, and 20% of 26,080 equals 5,216. Add them both up, and he's received 6,216 in total from the government, which was equal to the income tax he paid that year with the 3% contribution from the employer. So if Martin chooses to invest this tax year and chooses the S&P 500, which has averaged a return of 10% with a 3% employer's contribution, then he'll have to deposit 4,000 into his lifetime ISA, receiving 25% from the government, and he'll have to deposit 16,516.31 into his SIPP with a match of 1,350 from your employer, which in total means a deposit of 17,866.31 into his SIPP, receiving 20% from the government. Now he won't be able to do a lump sum deposit for this at the start of the tax year, due to the fact that the employer's contributions apply every paycheck. So this will affect the returns of the S&P 500, changing it from 10% to only 5.3% when investing an equal amount each month throughout the year. So 25% of 4,000 equals 1,000, 20% of 17,866.31 equals 3,573.26. So the total amount in lifetime ISA will be 5,000 at the start of the tax year. This is then invested in the S&P 500 with a 10% average return, meaning a balance of 5,500 at the end of the tax year. Now minus this from your initial deposit into your lifetime ISA of 4,000, and you have made 1,500. The total amount in the SIPP will be 0 at the start of the tax year. You'll be making monthly payments throughout the year of 1,376.36, and your employer will be making 112.5 per month. This is of course invested in the S&P 500, giving an average return of 5.33%, as well as the government 20% added throughout the tax year, meaning a balance of 22,582.31 by the end of the tax year. Minus this from your initial deposit into your SIPP, and you have a final balance of 4,716. Again, add your profit from your deposits into the SIPP and your deposits into your lifetime ISA, and you have 6,216 equal to the amount of tax you paid throughout the year. Now this is just some examples of loopholes that you can use as employees. Truth is, the rich aren't employees. They don't pay income tax, they pay corporation tax. Businesses can earn, spend money, then pay taxes on what's left over. Employees earn and they are taxed at source, then they can spend what's left over after being taxed. This is the main fundamental difference between employees and the rich. As an employee, I could earn, let's say, $100, pay 20% on tax on this, so now I'm left with $80 and then pay for my phone bill at $40. The rich would earn $100, pay for their phone bill for $40, then pay 20% tax on the remaining $60. Not to mention that income tax is 20% until $50,270, and it goes up to 40% for employees. The rich/corporations have to pay 19% on all income, whether they earn 10 million or 25,000. Quite frankly, majority of corporations will earn 200,000, but then spend all this, and what's left is 0, so they don't have to pay any tax. Whereas an employee could earn 200,000 and pay 20% from 12,570 to 50,270, then 40% up to 150,000, then 45% on anything over 150,000. Then after all these deductions, they can finally spend their money. With all that being said, that is the end of the video. If you enjoyed, please do subscribe, leave a like, and I'll see you in the next one.